The Peter Schiff Show.
Today's podcast is sponsored by NetSuite, the easy-to-use cloud-based business management software for every aspect of your business. Download the CFO's Guide to AI and Machine Learning at netsuite.com/gold. The guide is free to you at netsuite.com/gold. netsuite.com/gold.
Good evening, everyone. Well, this is another Friday night where earlier today we got a weaker than expected non-farm payroll report, although not quite weak enough, at least not based on the conventional wisdom. In reality, the jobs report was quite a bit weaker than the media is spinning it, and I'm going to get into that shortly. But the point I want to make right off the gate here is that the markets are set up pretty much exactly the way they were a month ago when I did a podcast on a Friday night where we got the July week non-farm payrolls report, and the stock market sold off, closed on the lows, hardest hit being the tech stocks, but also gold stocks were hit, all the cryptocurrencies were hit hard, everything was going down, and that's what prompted me to say that I thought the markets looked like they could crash unless we got the Fed to come to the rescue, because I thought that the markets at that time didn't know if the Fed was going to cut rates, because the last FOMC meeting, they talked about how good the economy was and how they still weren't quite sure that inflation was under control. And I said, the markets aren't going to like this. The markets are going to get hit. And I also pointed out the weakness in the dollar versus the Japanese yen. And that really blew up even more on the following Sunday night, where we saw a huge collapse in the Nikkei based on a rise in the yen and the fear of the unraveling of the yen carry trade. So I talked about all this, and I thought the Fed was going to have to do something to change the expectations, because the markets needed a rate cut, and a rate cut was in doubt. And I had mentioned that they probably should have cut in the prior meeting, and not waited for September. And then, of course, by Monday morning, when we had the big weakness in stocks overnight on Sunday and the market opened down, I thought, well, maybe the Fed is going to come out. And there was a lot of other talk about an emergency rate cut to save the markets. But then the bond market immediately started to price in a 100% probability of a September rate cut. And everybody had moved from 25 basis points to 50 basis points. And the markets then found some support with the solace that, okay, we didn't get the rate cut in July, but now we're going to get 50 in September. And that kind of put a floor under the market, and we got a bounce in stocks. And then a couple of days later, we got a lot of help from the Bank of Japan, like the Wednesday night, when the Bank of Japan came out and said, look, we're not going to hike rates anymore if it's going to cause instability in the markets. And that caused a big rally in the Japanese yen. And so we did get a recovery based on the idea that, okay, a 50 basis point rate cut is coming. But what's happened this week, and particularly today, is that the markets no longer believe we're going to get 50 basis points. The consensus is now for just 25. Now, everybody knows we're going to get a cut, but 25 basis points is not enough. And so we're right back where we were a month ago, where it looks like the markets could crash again on Sunday night. And those central bankers are probably going to have a working weekend trying to figure out what to do about it come Monday morning, because I think the Fed is going to have to do something to let the markets know that it's going to get 50 basis points. Because if it doesn't get 50 basis points, right, it's going to have a tantrum. And if you look at how the market closed today, this was, first of all, the worst week for the stock market, or for the S&P 500, since March of 2023. It was the worst week for the NASDAQ since sometime in 2022. Right now, the Dow held up relatively well on the week. And I've been talking about this, and that's because you have more defensive value type stocks. And even though we had a big drop during the week, we continued the rotation out of the momentum growth stocks into dividend paying value stocks. So the Dow was only down 1.2% on this week, but the S&P, which has a lot more growth oriented names, tech names, was down 3.8% on the week. And the NASDAQ was down 5.4%. The Russell 2000, which is very economically sensitive, and pretty much all the economic data we got this week was bad, right? Yet despite that, the markets are only thinking about 25 basis points, even though we know from the last FOMC minutes that there were some members who wanted to go 25 basis points last meeting, and they didn't do it. It wasn't unanimous. Some wanted to move. And so had they done that, now they do another 25, we'd be right back where they were. But even though we had all that weak news, the markets, don't think it's weak enough to prompt a 25 basis point cut. In fact, I'm hearing some people talking about the fact that the Fed better not cut 50 basis points because that'll scare the markets. The markets are going to think, oh my God, what do they know? They're cutting 50 basis points. Things must really be bad. Now, they are really bad. But I guess what people think the Fed should do is not let that cat out of the bag. So even though they know how bad things are and they think they should cut by 50 basis points, they're only going to cut by 25 because they don't want to scare people because they know they can't handle the truth. But the markets can't handle the lie either. I think they need to get 50 basis points, maybe more than that. And next week is the meeting, by the way. That's when we get the September meeting. I think it's Wednesday and Thursday, assuming the markets can survive without a huge crash between now and then. I don't know if they could accelerate. That would really scare people if the Fed came out on Monday and said, oh, we're not even going to wait to Wednesday. We're cutting rates right now. But they may have to do that depending on how weak the markets are Sunday night, Monday morning. But, look at how the tech stock got really hammered. The semiconductor names were among the weakest. In fact, the semiconductor index was down 11% on the week. NVIDIA, which is the darling of the AI bubble, NVIDIA was down 13.5% on the week. One semiconductor stock that's really been getting beat up is Intel. Right? Intel hit a 14-year low today. 14 years. And also, to put this in perspective, Intel today is 25% lower than it was 20 years ago. 20 years ago. Now, 20 years ago, Intel was the darling of what became the dot-com bubble, right? Intel Inside. All the computers had these Intel chips. It was like Intel, Cisco, right? Those were the Magnificent Two, or there was a few more back then. Broadcom, I forget all those stocks, AOL, whatever was, the equivalent back then of the Magnificent Seven right now. But that shows you how these stocks that are so universally loved can, become out of favor. You're talking about a 25% decline over 20 years. Who would have thought in 2004, when everybody knew that Intel was the stock you have to own, right? Because of the computers and the internet, you got to own Intel. Who would have thought that 20 years later, the stock would be 25% lower? And of course, inflation, we've had a lot of inflation over the last 20 years. So that 25% in real terms represents a much bigger loss of purchasing power. So everybody needs to keep that in perspective when you're thinking about all these hot stocks, these must-own stocks that people are buying today, and that includes cryptocurrencies. Look at what happened to Intel. The same thing can happen to a lot of today's darlings. But, also a good example of what I'm talking about the rotation into value. There are a number of stocks that we own in our portfolio that hit 52-week highs this week. In fact, even today, we had some stocks that were hitting 52-week highs. I'll give you an example. I've talked on the podcast about the tobacco stocks and why I think they're very defensive. They pay good dividends. And no matter how bad things get, people smoke. Even if the price of cigarettes goes up, they don't quit, right? They're addicted. So they keep on smoking. But British Tobacco was up 3% on the week. Despite, a bad market, it was up. Philip Morris International up 2.3% on the week. Those are two stocks that we own in our portfolios. In fact, year to date, British Tobacco is up 30% and Philip Morris is up 32%. That's on top of their dividends. British Tobacco's got about a 10% yield that you're getting on top of that 30% appreciation. Philip Morris is not quite as high. I think it's about 4 or 5%, but still well in excess of what you get in the S&P 500. But interestingly enough, the gold stocks were also among the weakest stocks of the week and of the day. The GDX was down 6.5% on the week, and the GDXJ, that's the junior gold miners, so they're more volatile, was down 8%. Now, you might think, well, gold must have really got clobbered on the week for the junior gold miners to be down 8%. No, gold barely went down. It was down about 0.8%. It closed about $2 below 2,500. Just about $30 below its all-time record high. Yet these stocks got killed. In fact, think about this. In order for the GDXJ to get back to where it was last week at its high, it needs to rally 15% to get back to where it was when gold was 1% higher than it is right now. I mean, that is amazing. That just shows you how scared the gold stock investors are of a weakening economy, because everybody still believes, we have a weak economy, right? That means that there's going to be no inflation. It's going to crush these gold stocks. The weak economy is what guarantees that high inflation gets much higher. People still don't understand the dynamics of inflation, where it comes from and how it works. But as the economy weakens, we get more money printing. We get more QE. So we're going to have higher inflation and we're going to have a much weaker dollar. And that is going to be very bullish for gold. It's just that these gold stock investors don't understand that yet. But anyway, let me get to the jobs numbers, the weakness in the labor market that is prompting the fear. And again, the number was weak, but what the markets are worried about is that it wasn't quite weak enough. There were some aspects of the jobs report that people think were strong, which wasn't even true. But the most people think that, and they think, this shows that things aren't that bad, and so the Fed doesn't have to cut by 50 basis points, and the markets are tanking. Oh, and let me, point out too, how much the cryptocurrencies, the Bitcoin ETFs were down 10.3% on the week, and the Ether ETFs were down 12%. Those Ether ETFs have only been around now for a couple of months, and they're already down 37% from their opening prints. That's a big move. And in fact, I crunched the numbers a little bit. Since the Bitcoin ETFs were launched in mid-January, if you bought them as soon as they came out, you bought the open, you're still ahead 10%, almost 10% on the year. Yet on the same day that all these 10 Bitcoin ETFs began trading, had you bought a gold ETF instead of the Bitcoin ETF, you'd be up 24% right now. So the people who bought gold ETFs, their gain is 140% higher than the people who bought Bitcoin ETFs. Now, who would have thought that, right? But this is just the beginning of the unraveling of Bitcoin. In fact, Bitcoin earlier today got down to about 52,500. It's bounced back up to close to 54,000 as I'm talking here. And Ethereum got below 2,200. We're almost at the lows that we hit that Sunday night. And in fact, Bitcoin itself got very close to 50,000, but then bounced. I think there's a very good chance that by Monday morning, we're going to be below 50,000 on Bitcoin. And if that's the case, it's going to be a long weekend for the people who own these ETFs, because they can't sell right until Monday morning. So if we start to see a big crash over the weekend, they are locked in, and they still haven't, capitulated yet. We have seen net liquidations from the crypto ETFs over the past week. but it's still small compared to the massive inflows that drove Bitcoin higher. And so I think we're getting very close to the puke point for these traders. And when they throw up and sell, it is going to be a complete bloodbath in the crypto spot markets because they're going to get overwhelmed. But we might see the beginning of this on Sunday night. Anyway, I'm going to take a quick commercial break, and when we come back, we're going to dig into the job numbers.
As a business owner, I know the challenge of navigating unpredictable markets, interest rates, and inflation. That's why having the right tools is essential. NetSuite streamlines operations and scales with growth. Over 38,000 businesses have future-proofed their business with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control needed to make quick decisions. You're peering into the future with actionable data. NetSuite is the platform that I would choose, and you should too. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/gold. The guide is free to you at netsuite.com/gold. netsuite.com/gold.
Yeah, before I get into the jobs data too, I mentioned just before the break about Bitcoin and gold. And based on where Bitcoin is right now, it's about 53,800, and where gold is right about 2,500. Bitcoin is now down, I think, 42% in almost 3 years relative to the price of gold. That is a huge decline over almost a 3-year time period. Yet people are still saying that we're in this big bull market. It certainly isn't acting like a bull market as far as I'm concerned. If you look at the massive decline, and of course, 3 years ago, none of the Bitcoin pumpers would have predicted, right? They all were writing gold's obituaries, right? Bitcoin was the new gold, right? It's going to take gold's market cap. Well, now gold is leaving Bitcoin in the dust. Now, a lot of the Bitcoin holders, I had this debate with David Lynn, hosted it with Jack Mahler. And, he's a nice kid. I mean, I hate to keep calling him a kid. He's, grown man, but I'm just so much older than him. But I admire the guy's passion, and I think he's sincere. I mean, I don't think, see, like a guy like Michael Saylor, I think he's full of crap. I think he's just saying stuff. He doesn't even believe it. But I think Mahler actually believes the stuff that he's saying. I think, he's wrong. But, these guys still won't acknowledge. And he kept telling me Bitcoin has succeeded as money. It's the greatest money ever. And I had to point out, it hasn't succeeded as money because nobody uses it as money. It's only succeeded in going up in price. It's succeeded as a speculative asset. But again, only if you bought it a long time ago. If you bought it relatively recently, you're losing money. I mean, even priced in dollars, Bitcoin is down, about 35 something percent. It was at 74,000, and now it's at under 54,000. So most people, I think, have lost money in Bitcoin. So it hasn't succeeded for the majority of people who own it. But yeah, it's succeeded, but not as money. It's only succeeded as a speculative asset because it was in a bubble. Well, that bubble's been pricked, and there's a lot of air that's going to come out. But anyway, getting into the jobs numbers, and I want to start not with today's report. I want to go back to the numbers we got on Wednesday, because we got the Jolts report. And the Jolts report is the job openings. The companies advertise all the job openings that they have. And so, the more open positions there are, right, the easier it is for people to get a job, because there's a lot of jobs out there. Although the problem is a lot of people don't have the skills necessary to qualify for a lot of these jobs that are open. And so if you don't have the skills, it doesn't matter how many of these jobs are open, you're not going to get hired, right? So that's a big problem. But anyway, people look at this as an indicator of the strength of the labor market. And the expectation was for 8.1 million job openings. And that would have been a slight decline from the 8.184 million that the government had reported were available the prior month. Well, as usual, they revised down the 8.184 million to 7.91 million. And the number we got for July instead of the 8.1 that they expected, ended up at 7.673 million, way below estimates. In fact, it was below the low range. The range was 7.8 million to 8.2. And again, we got 7.673. This was the lowest or the fewest number of job openings since January of 2021. Now, of course, we were still in the COVID lockdowns, right, in January of 2021. So we've got fewer job openings now when the economy is fully reopened than it was in January of 2021, more than 3 years ago. Clearly, the labor market has softened dramatically. Remember, the last thing that Powell said at the last press conference was any additional softness or weakness in the labor market is unwelcomed. Well, he's got a lot of unwelcome news that came out this week. And so that was the beginning. We got that horrible Jolts report. Then on Thursday, we got the Challenger job cut report, and there were 75,891 announced layoffs over the month. That's more than triple the number from the prior month. So that's very weak news as far as I'm concerned. And then we also got the ADP, that is the private sector employment report. That was supposed to be 140,000, which would have been an improvement from the 122,000 that they had reported for July. Well, July was revised down to 111,000. And instead of an improvement to 140, we went down to 99,000 jobs created. Again, below the low end of the range of expectations. So this was a very weak report, and it set the stage for the government's official employment report that came out earlier today. But, you know, the market was on the defensive going into this. The dollar had been weak. In fact, the Japanese yen closed the week. I started to talk about the yen at 142.3. This is the low for the year. In fact, I think we're going to take out 142 on Sunday night. And we're a couple of yen lower than where we were at the low point a month ago that sparked all the selling because of the nervousness about the unwinding of the yen carry trade. Well, now people should be even more nervous because the yen is even stronger now than it was then. And now it's got fresh momentum to have an even bigger move. And again, I keep talking about the Swiss franc, which also rose today against the dollar. The dollar was up against the euro, against the Aussie, the Canadian dollar. By the way, the Canadian central bank cut rates again. So the dollar rose against the Canadian dollar, but it fell against the Swiss franc. Again, a new 13-year low. The dollar is getting ready to collapse against the Swiss franc. And that really is the canary in the currency coal mine. When you see this kind of weakness against the Swiss franc, which is the real safe haven of currencies, right? Gold is the absolute safe haven from all currencies. But if you're going to stay in currencies, the one that's really the cleanest dirty shirt in the hamper is not the dollar, it's the Swiss franc. And everybody knows that. And so when you want to stay in a currency, you pick the Swiss franc. And the fact that the Swiss franc is so strong, not just against the dollar, but against all the other currencies, is a major warning sign. But anyway, getting to the jobs report from today, the August report. So the expectation was 160,000 jobs. And we got 142,000, which was, 18,000 below estimate. So it was a weak number. But who cares what this number is? This number is meaningless. I don't know why the markets even pay any attention to this number. They should just wait till next month after we get the downward revision, because we got about 100,000 jobs lopped off of the prior 2 months. So the July report that was initially reported, that was a very weak report, right, which prompted the big weekend sell-off. That was initially reported as 114,000 jobs created. That was revised down to 89,000. So it was even worse than they told us. But of course, I said that was going to happen last month. I knew that number didn't matter because they were going to revise it down. They may even revise it down again because they also revised down the June number, and that was a bigger revision. They took 61,000 jobs away from June, because I remember that when they originally reported the June number, it was reported as a beat because it was 179,000 jobs. It was actually ahead of expectations, and the markets rallied because we got a jobs number that was better than estimates. Well, now that number has been revised to up 118,000. So it's worse. It actually was a miss, but the market celebrated a beat. Why even pay attention? You know, they were talking today on television about how, well, you know, at least it's an improvement. We got 142,000 jobs in August, and that's a big improvement from the 89,000 that we now know that we got in July. And I'm thinking, well, how the hell do we know that we got 142,000 jobs in August when we know that this number doesn't mean anything? In fact, if they revise this number down by the same number of jobs that they just revised June down, it'll be less than 189. It'll be less than 89,000 jobs. So it won't be an improvement. In fact, the last 4 consecutive jobs numbers have all been revised down. So why wouldn't this one? Why wouldn't the 5th one be revised down? In fact, that's in addition to the broad 818,000 jobs that they took away when they revised all the jobs going back for an entire year. So these numbers mean nothing, especially the original print. So why anybody would look at that and try to, you know, say, oh, okay, well, look, we got 142,000. Things aren't as bad. Who knows what we got? All we know is it's something lower than 142. That number means nothing. We're going to get the real number next month and maybe the month after that. But of course, by then, nobody pays attention to the revisions. They start to look at the new number without realizing that the new number is a complete lie. And again, this can't be a coincidence. If it was a coincidence, 50% of the revisions would be up and 50% would be down. 90+% of the revisions are down. That's not a coincidence. That's deliberate. The government is overestimating the job gains when they know everybody's focusing on that month. And then months later, when they're focusing on a new month where they BS the number, then they make the revisions, right? This is the sleight of hand. They put up a big number, and then with their other hand, they revise down the numbers that they put out a month or two in the past. Now, what I think the markets were upset about actually was the improvement in the unemployment rate. The unemployment rate, which spiked up to 4.3% last month, came out at 4.2% this month, which was what they expected. But what I was hearing was, well, you know, so it's not as bad as we thought. There's no emergency. We don't need 50 basis points. We're not going off the rails, right? The unemployment did go down 1/10. It didn't go up, except it actually did go up. Because if you look at the U6 number, which is the one that includes the people that are working part-time that want to work full-time, and the discouraged workers who aren't even looking. But of course, you have to be discouraged for less than a year, because if you've been discouraged for more than a year, they don't count you anymore, even in that number. But the U6 number went up 1/10 unemployment. It's now 7.9%. And remember, that was the unemployment number. That was the only one that they used up until 1994. They had to invent the U3 in 1994 so they can lie to us and make the unemployment look lower. And that's, you know, they're using that lie today. But the actual number, although it's not quite as accurate, because back in 1994, the U6 included all the disgruntled workers, even if they had been disgruntled for 3 or 4 or 5 years, right? Long-term unemployed, we're still unemployed. Now, if you're a long-term unemployed, we don't consider you unemployed. You're just on vacation, right? So you don't show up in the numbers. But even with the way the government reports the numbers, we're at 7.9. That is high unemployment. Back before 1994, the only time you can find an unemployment rate as high as the one we got now is like at the depths of a recession. That's the only time we got unemployment as high as what we got right now. And they're claiming that we got low unemployment. We don't. This is a high unemployment, high inflation economy. But also digging down into the numbers, look at the private sector payrolls. These were big downward revisions. Last month was revised from 97,000 down to 74,000. 23,000 private sector jobs were eliminated. So most of the, in fact, all the reduction really came from the private sector, not the government sector. In fact, of the 142,000 jobs they claim were added, 118,000 of them were in the private sector. That means 24,000 were government jobs. And again, we don't want these government jobs. We need to get rid of government jobs. We can't afford to have all these government workers on the payroll. We are broke. By the way, the national debt between the last podcast spiked up above another little milestone. We're now above 35 trillion, 350 billion. We added that 350 billion in about 5 weeks. That's crazy. If you annualize that, again, it's $3.5 trillion a year. That's really where the deficits are. I've been saying they're 3 to 4 trillion a year, right? Officially, they're not even 2 trillion, but the official means nothing. You just got to look at how much the national debt is going up. That tells you the truth. But right now, Biden is on track to shatter Donald Trump's record for the biggest increase in the national debt in a single term. There's an outside chance, depending on what happens in the last few months of the year, where Biden might actually beat Obama and increase the deficit more in one term than Obama did in two. Now, Obama still has the record for the biggest increase in the debt under one president, but he had 8 years. Right? So Trump only had 4, and now Biden only has 4. He beat Trump, but it's possible. I don't think he's going to take out Obama, but I believe that whoever wins this election, even if it's Trump, whoever wins is going to break the record, is going to add more debt in 4 years than Obama did in 8. It is just going to be a massive increase in the deficit. But anyway, getting back to the numbers, manufacturing lost 24,000 jobs, 24,000 in 1 month. Now, the expectation was for a loss of 2,000. Now, they did revise the prior month up a bit from 1,000 plus to 6,000, but minus 24 was a huge number, which coincidentally, that's the exact same number of jobs that we added in the government sector. Think about that. We're basically replacing each manufacturing job with a government job. See, the problem here is the manufacturing jobs, these people are producing stuff. The government jobs aren't producing anything but red tape, which nobody wants. The stuff that the manufacturers, what they were making, people do want, people need. But we're not making it anymore. Again, that's why our merchandise trade deficit is skyrocketing, because we're laying off workers in America, and now we're buying stuff that workers in other countries produce, and so we have a bigger trade deficit. But also, when you are replacing goods-producing jobs with goods-consuming jobs, right? Because all the government workers do is consume, right? They don't add anything to the economic pot. They're not producing any real goods and services, but they're spending their paychecks. And of course, where are they getting their paychecks? The government runs a bigger deficit, so we have more inflation. But this is inflationary. We're going to make less stuff, but we have more people to buy the stuff that we didn't make. So this is a very weak report on the economy, but it's a strong report on inflation, because this change in the labor market tells you that prices are headed up quite a bit. Now, the labor force participation rate, that stayed the same at 62.7. A number that did, I think, scare the markets a little bit was the average hourly earnings were up a tad more than expected, up 0.4. The consensus was 0.3, and the prior month was 0.2. So this is kind of an inflationary number where wages are rising. And in fact, the year over year increase in wages went from up 3.6 in July to up 3.8 in August. And I think this is also one of the reasons that the market is getting nervous that we may not get 50 basis point cut because, this inflation news is a little hotter. And so that's why the Fed might just go 25, which is why the markets are so weak. And you're seeing this huge sell-off in the stock market because the markets need a bigger rate cut. And I think they're going to get a bigger rate cut, especially if we get a lot of weakness in the markets on Sunday. But, again, to me, it's not just that today reminds me of Friday a month ago when we had the exact same setup, but the whole thing, everything that's happening, to me, it's deja vu from 2008. Because back then, I mean, we really had this massive financial crisis that was just right around the corner. And to me, it was so obvious that it was coming. I mean, I had been warning about it for quite some time. I mean, the problem seemed very obvious, especially in the mortgage market, housing market, the banks. I mean, to me, this was like, just a no-brainer. The problem was too many people didn't have brains. Or maybe they had brains, but they were too focused on other things. They couldn't see the forest for the trees. So Wall Street was completely blindsided by the 2008 financial crisis. And then, of course, most of the big Wall Street firms who didn't see that crisis coming would have gone bankrupt had the government not bailed them out. Well, they're here. They're bigger than ever thanks to those bailouts, but they're just as blind as ever to an even bigger crisis that is just around the corner. And again, that crisis is going to really rear its head when the Fed is caught between the recession rock and the inflation hard place. That is where we're going. We're going to the point the Fed is going to cut rates. It's not going to work. We're going to have a recession, and people are going to be saying, the Fed waited too long. They should have cut rates earlier, right? They're going to try to say that was the problem, right? Waited too long to cut. The problem was they never should have cut initially in the first place, right? They never should have made that deal with the devil, right? You make a deal with the devil, eventually the devil's going to come collect. So it's, that is the problem. It's the deal. It was cutting rates to zero. It was doing QE. Once we did that, everything else was inevitable, right? The Fed already made the bed, and we're just lying in it. But they're going to cut rates. We're going into a recession. Recession is going to be bad. And then inflation is going to pick up because the dollar is going to roll over. Gold's going to break out. These gold stocks, again, they are giving these things away. As far as I'm concerned, it's like a free candy in a Cracker Jack box, right? You got to pick these up because Wall Street doesn't get it. They don't understand inflation. They don't know what's about to happen to gold, to the dollar, because the choice that the Fed has to make, again, and this is very important, they have to either allow inflation to run out of control and admit that they can't do anything about it, or the Fed is going to have to do an about face and abruptly start to raise rates after they've been cutting them. And if you think the markets are weak now, wait till you see what happens when the Fed pulls the rug right out from under them. If the Fed has to turn around and abort a cutting cycle when the markets are now pricing it in and pricing in more cuts and say, you know what, we're going to hike rates. And in fact, they're going to go higher than where they are now, right? We're going to have a real financial crisis that makes 2008 look like a Sunday school picnic. And the big difference is no bailouts for anybody. Because if the Fed is fighting inflation, nobody gets a bailout. Because the only way they bail people out is by creating inflation. That has been the solution to every problem the Fed has pretended to solve. They've created inflation. But now inflation is the problem. And they can't pretend that we need more of it because we're below their 2% target, right? Which we never were really below anyway. It was only because they make up the numbers. But even with the made up numbers, we're well above 2%, and we're going to be even further above 2% by the time this recession gets bad enough that the Fed is really under tremendous pressure. And when the Fed has to ignore inflation, because if the Fed does do the about face and we get the crash, the financial crisis, and no bailouts, and markets crash, stocks, real estate, banks fail, none of them get bailed out, which means it's not just the stockholders and the bondholders that lose money. Depositors lose money because the FDIC doesn't have any money. And the Fed's not going to be able to provide it with any money because it's fighting inflation. Right? And now the government has to cut spending in the recession. Right? Normally in a recession, what does the government do? It spends more to stimulate the economy. Well, if the Fed's not going to be providing the liquidity because it's fighting inflation, the government's going to have to cut spending in a recession. It also may have to raise taxes in a recession. We've never had that. Imagine, there's a recession, things are bad, and now your taxes go up, or you lost your government check that you were getting. And also, if the Fed is fighting inflation during the recession, interest rates go up. Well, we haven't had a recession like that. Every time we've had a recession recently, the bonus is interest rates go down. Okay, so the economy is bad, but I can refinance my mortgage. I can reduce my payments. I can get a better deal on a car loan, or my credit card debt goes down. This next recession, not only is the government going to have to cut spending and raise your taxes, but your interest rates are going up. So if you have an adjustable rate mortgage, that's going up. Your credit card debt payments are going. Imagine, this is the perfect storm of collapse. Americans have never lived through something as bad as they're going to live through if the Fed fights inflation, which is why they're not going to fight inflation. That's the whole point that I've been making. They're not going to. But now the pretense is over. The Fed has to stop pretending that they're going to be vigilant and they're going to do whatever it takes to bring inflation back down to 2% because they don't have the guts to do what it takes. Because doing what it takes means massive short-term economic pain, and the Fed wants no part of that. And so it's going to be inflation forever. Now, the problem with that is the markets are not going to like that either. No one's going to want to hold dollars knowing that it's a one-way ticket down. So there's a run on the dollar. And inflation just explodes. And it's not just everybody selling treasuries. They're selling every dollar-denominated fixed income there is. They're selling corporates. They're selling muni bonds, whatever they own. And now the Fed is buying all that stuff. They're not the buyer of last resort. They're the only buyer. And they're buying with a printing press. So we have either complete collapse or runaway inflation. Neither one of those is good. But the reason they're going to pick the path of least resistance, which is inflation, is because they're going to blame it on somebody else. If they do the right thing, it's obvious. If the Fed raises rates and causes this collapse, right, it's obvious that they did it. But if the dollar just collapses and there's massive inflation, we can blame speculators, we can blame China, we can blame Putin, we can blame greedy corporations, we can blame capitalism, we can blame everybody but the government, but the Federal Reserve. So that's where they're going to go. Plus, they probably don't realize how bad it's going to get, right? They think they can control this, right? They think they can get us a little bit pregnant with inflation without producing an actual baby, but they're wrong. You can't do this. They're going to lose control of the monster, and it's going to consume the country. And so that's part of the hubris to think that they could do this. Nobody has succeeded in doing this, but this is the revelation that is coming, and people are still clueless. I was listening to a Donald Trump rally. And one of the things he just proposed, and I'm not making this up, but he said that the United States should start a sovereign wealth fund, right? Like Norway has. We should start a sovereign wealth fund. Well, we're broke. We got sovereign debt. We have a sovereign debt fund. We don't have any wealth. That's the problem. We're 35.35 trillion in debt. What is the point of having a sovereign wealth fund? And where are we going to get the money? We're going to borrow money, so we're going to lever ourselves up. And what, we're going to put the U.S. government in charge? Some bureaucrat is going to be in charge of basically a levered up hedge fund that's 100% debt. We're going to just borrow all this money. The first thing we need to do is pay off our debt, because we have to pay interest on our debt. Like, we shouldn't even talk about a sovereign wealth fund until we get rid of the sovereign debt that we have, right? We got to get out of debt. It's like somebody, has all this credit card debt saying, well, maybe I should start, a brokerage account. No, pay off your credit card debt first, right? Dude, get out of debt before you start figuring out how to invest your money. The best thing you can do for a return is pay off that debt, right, that you already owe. That's because that's a guarantee, right? When you pay down debt, you have a guaranteed profit because now you don't have to pay the interest, right? So we should be focusing on paying off the debt, not building up a sovereign wealth fund that's going to increase the debt, right? Now, Donald Trump said, well, we're going to get all the money to fund this from our tariffs. And Donald Trump still defines the tariffs as their taxes on foreigners. So it's not going to cost Americans anything. We're going to tax the Chinese. We're going to tax the Germans, right? And we're going to take that money and we're going to invest it. The Germans don't pay our taxes. The Chinese don't pay our taxes. Only Americans pay our taxes. I don't care that you want to call it a tariff. A tariff is a tax. It's a tax on Americans who buy foreign products. And, or it's also a tax on Americans who don't buy foreign products because it makes the price of domestic products go up too, right? And you end up paying higher prices for everything. Now, again, I'm not necessarily opposed to using taxes as a way to raise revenue from Americans. I'd rather raise revenues through tariffs than through an income tax. So if Donald Trump said, hey, I'm going to lower the income tax, but I'm going to impose these tariffs. So instead of paying income taxes, everybody's going to pay tariffs. That's fine. But although Donald Trump is talking about lowering income taxes, that's the problem. Now, so is Kamala Harris now. She's talking about a $50,000 tax credit for somebody who starts their own business. I mean, right now it's $5,000. She wants to increase it tenfold. What a scam that's going to be. It's going to be just like the PPP loans. I mean, people are going to start fake businesses just to get the $50,000 tax deduction, right? Everybody who has a job will just start a little business on the side. And the minute you do that, you get a $50,000 tax credit. No, once they do that, of course, they're going to claim, look at all these businesses that have been started up. Yeah, they're all going to be fake businesses. They're not going to be doing anything. The only purpose of the business is so the guy who starts it can qualify for the $50,000 tax deduction. Look, all this stuff, everybody now, there's a bidding war going on between Trump and Kamala now, who can give away the most money, right? Everybody's going to cut taxes. Even Kamala is not even talking about these high capital gains. She's now lowered that down to 28%. I think she's taken the wealth tax off the table, right? Everybody is talking about spending more money, cutting taxes. What? Now, Donald Trump does talk about, well, we're going to have an efficiency committee. We're going to have Elon Musk head that so we can get rid of all the waste. Yeah, that's pretty much the whole government. It's waste. But even if you got rid of whatever they can identify as waste, it's a drop in the bucket compared to everything that's off the table, right? Which is interest on the debt, national defense, Medicare, Social Security, government pensions. I mean, all the big ticket items, nobody will touch them. So it doesn't even matter what you do with the rest. We're on autopilot for an explosion of debt, and everybody is, saying what they can give away. So this is a huge rude awakening, right? We're on the precipice of this collapse. And now I grant that we've been on this precipice for a long time, a lot longer than I thought we could have been. But, based on the numbers that we're looking at now, based on what we're seeing, it's clear that this is coming to a boiling point, and it's coming to a boiling point quickly, which is why, I talked to the guys again at Shift Gold, and people are still telling me they're waiting for a pullback to buy gold. You're not going to get one. Look, gold can barely get below 2,500. Of course, whenever it does, right, the gold people in gold stocks panic like it's about to crash. We are holding right near the all-time record highs, right? Unlike Bitcoin, which has collapsed from its record highs, real gold is right at the record high, which it's about to, launch from, as if that was a launch pad. We're going much, much higher. Don't even wait $100, $200. Who cares? Even if it falls, which I doubt, it means nothing in the scheme of things. You're waiting to buy your gold now. What happens when it hits 3,000, maybe later this year, early next year? What are you going to wait for 2,700? And while you're waiting for 2,700, it goes to 3,500. Save yourself some stress. Just buy it right now, right? You're going to get a good buy. Gold is still very cheap. Same with silver, about $29 an ounce. I mean, it is going to blow through 50, I think, like a hot knife through butter when it starts to go up. You know, the sentiment is still so bad. You know, every time I saw a First Majestic Silver, you know, they announced a buy, stock gets hammered. I mean, anytime a gold company has any kind of news that they're acquiring something, or if they miss their earnings, they just get taken out to the woodshed, because that's how little faith, even the gold bugs who are buying gold stocks, because who else is buying them? Because most investors, the general public, they're not buying gold stocks. The institutions, the hedge funds, no one's buying these stocks, right? Now, soon everybody's going to be buying these stocks, but at much, much higher prices. They're not buying them at these prices. They're going to be buying them at prices that are multiples of where they are right now, which is why I'm telling people, do not wait, right? This is the gift horse that you don't want to look in the mouth. You want to load up on these stocks, just like we've already seen the change in the momentum stocks, the value stocks, like some of the other stocks that we own, like Danone, a food company, hit a 52-week high this week. Singapore Telecom, another stock we have in the portfolio, hit a 52-week high. Vodafone hit a 52-week high. I'm looking at, I forget all the different stocks. We have some of our pharma stocks. I think Glaxo, Novartis, I think both of those hit 52-week highs. These defensive kind of names, right, are finally really starting to perform. The gold names, they're the most defensive stocks there are. People just don't realize how defensive they are, because the risk is inflation, right? It's dollar devaluation. Gold stocks are value and defensive stocks all in one. And the markets, investors have no clue what's going on here. So while they're clueless, should be buying these names. You should be buying the Euro Pacific Gold Fund. EPGIX, I think, again, is the symbol for the no load version of my fund, which you can buy at any of the discount brokers. I always forget these symbols. But it's the Euro Pacific Gold Fund. But you want to buy the investor class. But you also could just, look them up on the website at europac.com, europac.com. Talk to one of the representatives at Euro Pacific Asset Management. If you're going to buy just your physical gold, now you don't even have to talk to anybody. Again, you can go over this weekend and you can buy gold just below 2,500 an ounce. You can buy silver with around 29. We got, the shopping cart. You could just go on my website 24/7 and input your information and buy your physical gold and silver. You can see these prices. They're real prices. You don't have to wait. Now, remember, when I did this a month ago, I mean, gold is higher now. It was, I forget, it was like 2,400. So it's up like $100 since where it was a month ago. But we didn't get, or was it 2,500? Maybe it got up to 2,500 back then. I think we got near there. So, I mean, we didn't get the big move the following Monday. We got a bit of a pullback, but we're right back where we were. But one of these Mondays, it's going to happen, or I think it's going to happen on a Sunday night. You're going to really start to see the move, because today's jobs number was weak. Right? The only part of it that they thought was strong was the fact that the 140,000 jobs that we got for the current month, 142,000, was better than the prior month. But how do we know that that's the right number? We know that it's going to get revised down. We just don't know how low and how many times it's going to get revised down. But the manufacturing was a disaster. Manufacturing has been in recession for over 2 years, even using the government's own numbers. And we got more ISM and PMI data earlier this week. I didn't even quote the numbers. It was all bad. All these numbers are recession. I don't even think we've ever had a manufacturing recession that's lasted this long. The biggest irony is Biden keeps talking about the manufacturing boom when there's a manufacturing bust. I mean, George Orwell, right, would be proud of this, right? Goebbels would blush to get away with this kind of propaganda, right? You're talking about a boom with a straight face when your own data shows that we have a bust. But again, Donald Trump did the same thing. He talked about the manufacturing renaissance, how all these manufacturing jobs were coming back when we were losing more manufacturing jobs when he was president too. And in fact, the only manufacturing jobs that we gained, right? Biden wants to talk about all these manufacturing jobs that he created. He didn't create any. We've lost a bunch of manufacturing jobs. But early in his presidency, yes, there were some manufacturing jobs, but they weren't created. They already existed. They were the manufacturing workers that were furloughed during COVID, right? They got recalled. They came back to jobs that already existed. And Biden says, oh, those are my jobs. I created those jobs. He didn't create anything. We've been losing all these manufacturers. This is a horrible recession. The manufacturing recession is so bad that even the government numbers can't hide it. Now, I think the overall economy is in recession too. It's just not as bad. And so the phony government statistics have been able to cover that up. The question is, how much longer will they be able to do that? And again, when are we going to get more revisions that are going to blow away the smokescreen and reveal the recession that's been lurking beneath the surface? Again, that is why Biden was the most unpopular, is the most unpopular president in modern history ever since they've been doing these polls. It's why Kamala Harris was the most unpopular vice president in history, because the economy stinks and the voters are blaming the incumbents. And, yes, they were able to manufacture through the convention and all the concerted effort of the media and their, contrived polls. They were able to manufacture this bounce, but that's going to fade as quickly as this illusion of a strong labor market. And I still think that Trump is going to end up winning the election. The problem is, people are expecting a panacea. Oh, we just have to elect Trump and everything is going to be great. No, it's not. It's going to be horrible. It's going to be worse. All the problems that Trump thinks he's going to solve are going to get worse when he's president. And so the fact that nobody is prepared for this, that is a problem. But, it's still better than having Harris as the president. Because, again, we know for a fact that Harris doesn't like capitalism, right? She grew up a Marxist. And so she is waiting for any kind of economic disaster to say, I told you so. Capitalism doesn't work, right? We need to implement this centrally planned socialist economy because these greedy capitalists have destroyed the economy. They've brought it to its knees. And this is proof, right? She's so they will exploit that. Donald Trump and the people who are likely to be in his administration like capitalism. They may not understand it perfectly, but at least they like it, right? And they don't like socialism. And so they're not going to use this collapse as a means to implement those type of socialist policies. But it's unfortunate because when it happens on Trump's watch, it's possible that it might make it easier for people to say, you see, right, Trump did it, which is why it's better to have this whole thing start before the election. I really think, because not only does that ensure that Harris doesn't win, but at least it makes it harder for anyone to blame it on Trump or blame it on any Republican policies if the Republicans don't actually have an opportunity to put any of their policies into action. If the whole thing implodes before Trump even takes office, I think we're in a much better position to introduce the type of solutions that would actually work. But in the short run, dollar's going a lot lower, inflation's going a lot higher, gold's going a lot higher. This is all inevitable, right? You can't stop this from happening. All you can do is clean up the mess after the fact and try to create an economy where we can have a permanent, lasting economic growth and prosperity. But before we get there, we have to deal with the problem. And believe me, it's a huge problem because we should have dealt with it 10, 20 years ago. We kicked the can down the road, and now it's going to be much worse. But regardless of that, I think that the investment strategy that I have been recommending and I have been following myself is going to bear tremendous fruit. And at least that's going to be a consolation, right? At least during this collapse, at least we'll end up wealthier individually on the other end of it, which will not only help us deal with the economic collapse, but actually better position ourselves to help others and to help the country and to have some credibility with other people on the recommendations on the path back to prosperity. Anyway, we'll see what happens on Sunday night. It was a month ago that I did that impromptu spaces on X because of the carnage that I saw in the markets on Sunday night. And we may see the same thing. We may see the futures down dramatically. Maybe we'll see gold way up. That's hard to say because everything is selling off right now. But I eventually gold's going way up. But we could see a big drop in the stock market futures, a big drop in the dollar yen, big drop in the dollar Swiss franc. We could see a crypto crash on Sunday night. So if we really start to see a lot of things unraveling this Sunday night, the way they did a month ago Sunday night, when we had pretty much the exact same setup that we have now, except things look even worse now than they did then. I'll probably do another one, although there is going to be NFL. But so I guess I might have to miss the Sunday night game if things really, if there's a lot of fireworks and I really feel that I want to talk about. But at least I'll be able to watch the games that take place during the afternoon. Anyway, again, don't forget, you like this podcast, give it a thumbs up. You like the video, like it, comment on it. Again, if you're still not subscribing to my YouTube channel, even if you don't listen to my podcast on YouTube, go to my YouTube channel and subscribe anyway, because I gotta pick up my subscriber base. I still don't have 600,000 people who are subscribing to my YouTube channel. I've been stuck at this number for quite some time. I'd like to get a 600,000. So if you're not a subscriber, go ahead and subscribe. And speaking about subscribing, if you're not subscribing to Shift Sovereign, the newsletter, the free newsletter, if you're not getting that in your inbox daily, make sure you go to shiftsovereign.com, give us your email address, get the free letter, and check out the premium letter. You can try it for a month for free. Shift Sovereign Premium, you get a lot of value for not a lot of money. And I will be back again with more podcasts next week. So thanks for being here, everybody, and bye for now.